Tensions are heating up around the world. Conflicts are starting to escalate, and that has made its way into the financial markets. Cryptocurrencies got hit the hardest, with Bitcoin nearly down 10%. Wall Street futures are down nearly 1%, and this could send commodities absolutely bonkers on the open on Monday. So what should we be looking at in times like these? So today we're going to be looking at the fundamental, the macro, and the technical, starting with the big week of earnings ahead and how we're currently tracking this earnings season. So far so good, but are we due for volatility? Today we'll be asking and answering that question, as well as looking at sector valuations. We're going to be talking about what is cheap, what is expensive, and where can we find value in what is a pretty expensive market. We're also going to be talking about PayPal. This is the latest stock in my portfolio, and I'm going to tell you why. So sit back, relax. We've got a lot to talk about. Let's roll the tape. Welcome everybody to a special weekend edition of the show. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. This is the weekly heat map of the S&P 500, and guys, very red across the board. This week was a liquidation. People wanted to get out of the capital markets and they just want cash. They want to hold cash because there's geopolitical concern, inflation concern, economic concern, concerns everywhere kind of all piling up in 1 week, and people fled. We know it was a liquidation. Look at utilities, look at telecom services, look at consumer defensives, look at healthcare. They were red. There was no defensive rotation this week. It was just get out of stocks. And when people go ahead and just start liquidating stocks, the stocks they are going to hold is Amazon, Google, Apple, Nvidia, Walmart, Costco, the best stocks, the biggest stocks in each sector with the best balance sheets and the best business models that can ride out pretty much anything. Those are the stocks that are going to get bought, and we saw that. So this week was clearly just get out of stocks, give me something safe, give me cash, and if I am going to hold stocks, it's going to be the highest quality stocks with the best balance sheets. Now looking at sectors this week, GDX was the best performing sector, but it was still down 0.24% for the week, and that's a telltale sign. Same here with technology, semiconductors, discretionary. Okay, they were the best performing sectors this week. In fact, the Nasdaq was only down 0.54%, and that was that flight to mega cap quality, especially when a whole bunch of concerns all pile up in a single week. Look at the worst performing sectors, rate sensitive sectors, ITB, XLF, KRE, so like financials and home builders. Anything exposed to real estate was not the best performing sector. The SPY was down 1.46%. And looking at the other majors, look at GLD. Okay, so gold was actually up 0.81% for the week. The Nasdaq down 0.58%. Look at bonds. Bonds was down a negative 0.74%. The SPY 1.56. The RSP 2.65. So the broader market lost significantly. And again, that goes to show the mega cap trade. And then high beta IWM down 2.82%. And a very rough day across the market this week. And that's just that's exactly what happens. When there's a flight to safety, people are going to buy gold, people are going to sell high beta, and they're going to go into mega cap names, high quality, great balance sheets. Okay guys, we're going to look at the IWM today, small caps. Yesterday we looked at the S&P 500, so if you want the full multi-time frame analysis for the S&P 500, go ahead and check that out. Now drilling down, this is the weekly chart in the IWM, and we can see a couple of very glaring things. Number one, we actually are in an uptrend. Let's not forget the overall trend. We put a low, higher low, and then a 52-week high. At the same time, we put a high, made this low, then made a higher high, and then made another 52-week high. That being said, we do have to recognize the fact that these candles are looking very grim, and they are approaching a very critical zone, which is this zone right here, the top of this multi-year balance range where we used as resistance and then somewhat turned to support. We've used this line to break out to the upside out of this balance range. Now, if we break below this line sometime next week, close below maybe a daily close, even a weekly close, we're back in this balance range, and who knows where we go from there. The likely levels that we could reach is, here below the 1960 level and even as low as 1720. That being said, we are still in an uptrend, and really this massive downtrend on a weekly chart is only really violated once we break below this 1920 1900 level. Drilling down into the daily chart, you can see see that we are in an uptrend. There's no doubt about it. We put a low right here, making multiple higher lows all the way up to where we are right now. At the same time, we've made multiple higher highs and put in a 52-week high at the top. Now, zooming in, this is where it gets a bit grim, because on the way to that uptrend, we have put in a succession of lower highs right here and lower lows on the way down to where we are right now in this zone right here. So I would say that while we are in a weekly uptrend, we are in a daily downtrend, and especially approaching this critical level. I would say that this 2000 level is very, very critical, and if we break below, we could really see some downside action in the IWM, particularly if stuff like yields are to spike up, if gold is to keep rallying, if we do see the dollar increase. That's really going to affect small caps in a very negative way. So where do we go from here? Right now, it's make or break in the small caps, and I would say this level right here is an absolutely critical level. This is that major low we formed before we actually went on this massive uptrend. We break below here, and then we are going to see significant downside action. So there is support for the Russell coming here at this level. What is this level exactly? It's 1956 and then to 1900. So 1950 to 1900. I know it's a very big range, but that is the range we're working with right now. And it's two things for the Russell right now. Either we're going to bounce right here and clear some of these highs next week, or we're going to break below this 2000 level right here, 2019 level, and make our way all the way to 1956. I think the second we break below here, have some price discovery below this line, we're going to go straight into this massive zone right here, and then it becomes absolutely critical for small caps to find support, because this is the last leg of support before the 1700 level right here, 1702, and then we can see some real downside in the small cap markets. And that might be a headwind for the S&P 500 as a whole, but right now things are looking very, very critical for small caps. And it's so crazy how things can change. Just a couple of weeks ago, we were looking at 52-week highs, breaking all-time highs in the Russell 2000. A couple days later, 1 week later, 2 weeks later, the narrative has totally changed, and now it's looking critical. So guys, things can change in a heartbeat here in the financial markets. One of the biggest reasons why we got that vicious sell-off on Friday had to do with geopolitical concerns. Now, this is straight from the BBC, and I don't want to get monetized. I don't want to get a community guideline strike, so I'm going to use very vague terms. Joe Biden expects this country to attack this country sooner than later, and the word on the street is it's going to happen this weekend. All right, guys, we don't care about the community guidelines or whatever. We're just going to report the facts of the situation. By the way, this is from the New York Times, and this is essentially the situation. Iran has launched hundreds of UAV drones at Israel. Those drones took roughly 8 hours to get to Israel. Iran, Iraq, Israel suspended all commercial flights in their area, as well as a bunch of other countries in the Middle East. 99% of all drones that were launched at Israel were intercepted. So I'm assuming that means 2 or 3 drones probably hit. I think there was something like 263 drones in total. Israel has promised a significant response. Iraq has officially declared the attack is concluded. Tensions heating up. I guess there wasn't anything significant, but it's less about, any damages that were occurred and the fact that this attack actually did happen. There were drones launched. There was videos. Very, very sad situation. I hope everybody's okay. I'm a pacifist at heart. I believe there shouldn't be any type of war, but this is what it's come to. These are the facts. I believe Bitcoin was down 10% in weekend trade. Weekend Wall Street was down like 1%. So we're going to see how the markets react to this. I'm assuming we're probably going to see bonds rally, oil spike. We're going to see some pretty brutal downside action in the markets, Monday, Tuesday across the globe. Looking at sentiment for the last 1, 2, 3, 4, upward of 2 to 3 months, we've been in stretched positioning. We pulled back this week here to the 0.2 mark. And while we are still above the historical norm with regards to sentiment, this is a big pullback, and it just goes to show the bearish sentiment that's come into the market. At the same time, the BOFA bull bear indicator went from 5.3 to 5.2, and just a couple of weeks ago, this was at 7. What these indicators are telling us is that you need to start putting stocks on your watch lists and getting ready to buy the dip, because a dip is coming sooner rather than later. So we are still in this neutral territory where it is still hold equities, but these indicators are definitely moving towards the buy zone, which means equities are going to pull back. That is bearishness in price action, but it does make the opportunities in the market far more attractive. And we do have to watch these sentiment indicators week after week just to see where positioning is, because they can move very drastically and then we can often miss the move. You do have to understand that topping right, is a process before stocks go down, whereas bottoming is an event, okay? So it's very, very quick, and that's why you have to pay attention to the sentiment indicators every single day. Subscribe to my channel because we go over all of the sentiment indicators every single day, so you never miss a beat. Subscribe below and hit that notification bell, guys. Now, let's actually talk about what happened on Friday. The VIX spiked 18%, but we still remain under the 20 level, and this is the S&P 500 after the VIX jumps 40% in 10 days, but the VIX level is still below 20. And we can see here that the returns tend to be positive 1 week later, 2 weeks later, 1 month, 2 months, 3 months, 12 months. It all tends to be positive, but we have to dig a bit deeper. So you can actually see here 1 week later returns of 0.4%, then here 1.8%, 2 weeks later, 1 month later, another 1.8%, 2 months later, 1.5%. So essentially, when the VIX spikes up more than 40% in 10 days, it's pretty much telling us that anywhere from 1 to 2 months, we can pretty much remain flat in stocks, which means we're going to get a bit of upside and downside volatility. We're going to trade sideways, and pretty much this is telling us that we're probably due for a correction in time. We could even see that 3 months later, only 3.2% returns, and then it does get a bit juicier 6 months later, 12 months later, double-digit returns, high percentage win rates. And essentially what we are looking for in the next 1, 2, 3 months is just a buyable dip opportunity for what is a very strong bull market we're currently in. And this right here, the VIX increasing more than 40% in the last 10 days, but staying below 20, could provide us with that opportunity. And just for the record, if stocks trend sideways, that is also a correction. It's just a correction in time. And if earnings come in the way that we expect them to, stocks will actually become cheaper on an earnings basis. Now let's actually talk about earnings next week. We got a very big week starting here on Monday. We got some more financial names, Goldman Sachs, Charles Schwab. This is in the undervalued portfolio, by the way. We might cover them on Monday. We got First Bank, but nothing too big here on Monday. Then Tuesday, we have Bank of America, United Health, Johnson & Johnson, United Airlines, Morgan Stanley. So again, another big financial reporting day, but then we also have some of the healthcare names and a couple of other stocks here that you guys might hold. Then Wednesday, ASML, a huge barometer for the semiconductor industry. Then we have Abbott's Laboratories, as well as a couple of other financial names, US Bancorp. And then we also have Discover Financial, which is a barometer for the payments industry. And if Discover reports good earnings, generally speaking, all payment providers report good earnings. Then Thursday, we have TSMC, another semiconductor barometer, Netflix, Intuitive Surgical, the Blackstone Group, private equity. Love to see how they're doing. So a big day on Thursday. And then Friday, we have American Express, Procter & Gamble, SLB, and a couple of other names I don't know. But all in all, a very dense week of earnings next week. And this is what earnings look like for this week so far. So 29 companies of the S&P 500 have reported earnings. Right now, blended growth is 2.7%, excluding energy 5.4%, on revenues of 3.3% and 4% excluding energy. Now do take into consideration that right here, a one-time charge related to Bristol Myers Squibb, BMY, has impacted the overall index growth rate. When excluding BMY from the index, the S&P 500 2024 Q1 adjusting earnings growth rate improves from 2.7% to 5.8%. So we are actually reporting 5.8% growth. It's just that this one-time charge of BMY is affecting the index greatly at the moment, but we'll see how that pans out for the rest of earnings season. And so far, 82% of the 29 companies have reported above analyst expectations. So far, earnings are looking pretty good, excluding this one-time charge from BMY. So where does that leave us with valuation? So right now, the S&P 500 is valued at 20.8 times forward PE. The PEG is 1.3 times and a 3.4% free cash flow yield. So even though it's slightly cheaper than it was last week at 21 times, it's still pretty pricey in my personal opinion. I'd love to see this get below 20. That would be really, really awesome. Now our EV to sales is 3.1 times. Yeah, it's all right. And then EV to EBITDA 15.3 times. I guess it's all right as well. A bit pricey compared to, other stocks that you can find on the market. But then you have a look at these names. Look at energy, guys. Can you believe that this was 9 times earnings at the start of January? It's now trading at 13x. Financials at 15x, the second cheapest sector in the S&P 500. The most expensive sector, information technology at 28 times, a 1.5x PEG ratio, and a 2.6% free cash flow yield. So tech looking very, very pricey, but on a PEG basis, not as pricey as some of the other sectors. Some middle of the road sectors, healthcare, comm services, 18, 19 times, 1.1 and a 1 PEG, pretty attractive, 4.8 and 4.2% free cash flow yield, and a EV to sales of 4.1 and 1.9. Wow, that is crazy. So yeah, so that is not too bad at all. So guys, if you want value, look at healthcare, not a bad place to look. Look at comm services. They do look like they're trading at a very reasonable multiple compared to their growth, but the data's here for all of you guys to see. And personally, I like looking at a free cash flow yield and PEG. Those are the two metrics I use to evaluate on a relative value basis. Now, data next week, so there's nothing major like inflation or employment, but the focus will be on retail sales, housing starts, permits, existing home sales, and industrial production. So we're sort of getting these indicators that's going to tell us how the economy is faring and give us a bit more information as to how everything's looking on the inflation front, particularly retail sales, empire manufacturing, housing starts as well. This is a big one. And then we have jobless claims and a couple of other indicators here towards the end of the week. Now let's talk about PayPal. Guys, today we're going to talk about PayPal. PayPal is the second stock in the YouTube public portfolio, and I thought I'd give a rundown, my thesis, what I think of it, my fair value price targets, and what I think the stock is going to do, and also my expectations of management. Now, PayPal year to date has actually returned 5.18%, so it's actually underperformed both the Nasdaq and the S&P 500. However, on a peak to trough basis where it troughed out here in February, the stock is upward of 15%. So had you bought at the right time, you'd be sitting pretty on quite a lot of gains. Now, the reason why PayPal is on everybody's lips has to do with the fact that in the last couple of years, it has done absolutely terrible in returns for investors. You can see in the last year, it has returned negative 12.22% in a bull market. And in the last 5 years, PayPal has lost 39.3%, but that's not to go unnoticed. You can see actually here during the everything bubble in 2021, PayPal actually ran up very close to 200%. On a peak to trough basis, it was close to 250%, but has pared all of that losses and then some, having a peak to trough drawdown of close to 82% with a bottom formed here in October 2024. And many people compare PayPal to Meta. Meta had a very similar situation during the everything bubble. They absolutely ran, and after a lot of controversy in the media as well as the metaverse, the stock had a pretty terrible drawdown, very close to 70%, going from about $400 a share to about $78 a share, but has then since rocketed up all the way above its all-time highs to where it is right now, and is one of the best performing stocks in 2023 and one of the best performing stocks in 2024 with this monstrous run. And many people believe that this right here could be PayPal's moment. So today we're going to talk about that to see if this is PayPal's meta moment. But first, let's actually talk about what exactly PayPal does. Now, PayPal operates a technology platform that enables digital payments on behalf of merchants and consumers worldwide. It operates a two-sided network, so it services businesses and consumers. So let's talk about the consumer first. They essentially provide payment solutions to help people manage and move money both domestically and internationally. They offer credit services that are accessible and cost-effective. They facilitate simple, secure, and payments across devices, and they deliver flexibility with payment options globally across platforms. And then on the merchant side, they offer tools and insights to attract new customers and increase sales. They help identify fraud and improve risk management. They offer access to seamless credit solutions to enable growth and power all aspects of digital checkout online and mobile for any consumer, both if they're in the PayPal ecosystem or not. So let's dive into the financials of PayPal right here. So PayPal's revenue has increased every single year since it went public in 2015. This is fantastic revenue growth. And you can see from about 2019, 2020, PayPal has actually almost doubled its revenue growth from about $15 billion right here to very close to $30 billion. And they are expected to report $32 billion of revenue here in 2024. And while PayPal's revenue growth is stellar, what does concern the market is its decelerating top line growth. You can see that in 2020, 2021, growth was well above 20%, and it has since decelerated to about 8% of top line growth. And that number has also decelerated from 2016, where PayPal was posting double-digit revenue growth and even upward of 20%, and we have now since seen revenue deceleration to single digits here in 2023. Now, looking at EBITDA, which is essentially PayPal's earnings minus one-time expenses stripped out, stuff like taxes, interest expense, depreciation, you can see that EBITDA has also increased very, very steadily, but has since flatlined in the last couple of years. EBITDA has virtually gone nowhere since about 2022. Yes, there has been a slight increase, but really this chart should look something more like that, and it simply hasn't, and there's been a lot of impact affecting PayPal's EBITDA. At the same time, earnings per share has actually declined quite significantly. We could see that the peak year in 2021 at $4.50 per share has never been achieved. However, the last 12 months, we have actually reported $3.85 in earnings per share, and PayPal is expected to report more than $5 earnings per share this year. That being said, we do have to look at the data, and earnings per share hasn't even been stagnant. It's actually decreased in the last 2 to 3 years. Now, looking at free cash flows, PayPal's free cash flow peaked here just before the 2020 pandemic, very close to $7 billion in a single year. The most recent last 12 months was $4.22 billion, and you could see that PayPal has definitely come down from its peak. But if you actually look at it over the last couple of years, PayPal's free cash flow has pretty much remained stagnant. There hasn't been much growth in free cash flow, and ultimately this is what investors look at, because this is the amount of money that can be returned to shareholders at the end of the day. And this is the problem with PayPal. Even though they've got stellar revenue and their EBITDA kind of looks good, when you dig down deeper into the business, their free cash flows as well as their earnings per share is reflective of their stock price. And when you have a company that's priced for growth and that growth doesn't materialize, you get a price chart that looks like PayPal's. Now, a lot of PayPal's current problems has to actually do with their previous management team. They have since removed their previous management team and put in a new team with Alex Chris, a new CTO, a CFO, and a bunch of other people have come into the business, and they are committed to profitable growth and increased operational efficiency and operational leverage. And we're starting to see that. Now, this right here is PayPal's income statement, and you can see here that revenue has remained consistent. We looked at this chart previously, and so too has the cost of revenue. But since the new management team, operating expenses have actually been decreasing since 2022, and this is in large part due to layoffs as well as streamlining the business and making it far more operational efficient. And we can actually see that this is being reflected in the bottom line. If we scroll down to operating income, we've had the most operating income ever of $1.733 billion here for PayPal, and this is starting to be reflected in free cash flow. We looked at this chart earlier too, but we can see that on the quarter, free cash flow is at $2.47 billion, and it's the second highest amount ever. And this right here was actually an outlier that had to do with cash from operations that got attributed as free cash flow for that quarter, and that's why it's so high. And when you look at this in hindsight, this is the most amount of free cash flow the company has ever produced, and this just goes to show management's operational efficiency. At the same time, what we've also seen is PayPal's transaction take rate been on the decline for quite a number of years. However, we have seen the recent management team turn this around, because if we break the annual take rate into quarterly, we can actually see a huge jump right here. And if management can continue to keep the quarterly take rate above this 2% mark, get a full year reading at the 2% level, you're going to look at substantially higher revenues for PayPal, because the overall payments industry is expected to grow 10.7% in 2024, and PayPal is a beneficiary of that. And ultimately, that growth will be reflected in a higher TPV, total payment volume, and with a higher take rate, that means PayPal's revenue will enlarge, just automatically be higher, and even higher than the street's expectations. Now, there's also a lot of chatter about PayPal losing market share, and I found a really interesting note from Wedgwood Partners. And Wedgwood Partners talk about growth rates in the payment industry, and they say here, obviously, smaller companies will mathematically have an easier time showing faster growth rates than larger companies due to growing from a lower base. More to the point, this also doesn't mean that large companies have necessarily lost share in the industry if they continue to grow along with the broad industry. Very, very key. To track broad industry growth for PayPal, we follow the company's total payment volume, TPV, in relation to Visa and MasterCard and the broad US e-commerce growth. As you can see in the chart below, PayPal routinely tracks at or near the top end of these broad industry trends. So arguments regarding share loss is puzzling to us. So Wedgwood Partners actually make an argument here saying that PayPal isn't actually losing market share because they're growing right along industry trends as as well as tracking at or above Visa and MasterCard. And these are the two heavy hitters in the payment space. And really, this is the growth rate you should follow, Visa and MasterCard. And PayPal, this dark blue line right here, tracks above, sometimes below, but generally in line or above US broad e-commerce growth. So, PayPal losing market share might actually be a narrative that was just drum up for people who didn't really have all the information. Now, PayPal is trading pretty close to all-time lows. You can see here that the stock is still down 39%. And yes, it's had a very good run from the bottom in October. That being said, you can't deny the fact that looking back at all of this, it does look attractive just from a visual standpoint, and that the stock still has a lot left to run. Now, the one advantage that this management team has is that this right here, PayPal is at all-time lows. And I do think PayPal's biggest advantage is share buybacks. The management team are on top of this. The management team did $4.88 billion worth of share buybacks last year when the stock was anywhere from $50 to about $65. And that means they were buying stock at dirt cheap levels, very, very undervalued levels. And that's exactly what you want to see from a management team. The management team have also committed this year to at least $5 billion in share buybacks, and that would be an 8% reduction in the share count at the current prices. PayPal's balance sheet is also really, really healthy. They have $20 billion in cash and cash equivalents and total debt of $9.68 billion. That's $10 billion net of cash, and their equity book value is $21 billion. So they have a very, very healthy balance sheet. Now, where does that leave us with valuation? Because ultimately, that is what we're here to answer. And I've got three valuation metrics for you. I've got the worst case scenario, a base case, and the best case. And we're going to go through all of it here together. So I've used some basic assumptions. We're looking at $4.22 billion of free cash flow for 2023. That's our base figure for all of this. We are using a cash component of $20.13 billion as per the balance sheet, and then total debt of 11.3, which includes long-term and short-term debt, not just the long-term debt. And then shares outstanding is $1.71 billion. Now, management have committed to buying back $5 billion, which right now is about 7% of the share float every single year. But for all of these assumptions, we're not using a decrease in shares outstanding. Now, for the worst case, we're using a growth rate of 5%, very conservative, and then a discount rate of 10% and a terminal rate of 0%. Now, PayPal's EPS growth rate is under contention. Many people have many different estimates. If you go to Yahoo, go to the analysts tab and go right here to next 5 years per annum, you're looking at a 19.8% growth year in PayPal per annum. And then next year, you're looking at 10.5%. Now, this is earnings per share growth and not revenue growth. You could see here that in the revenue estimate for next year, 2025, is 7.8%. So using a 5% growth rate is very, very conservative. Stock analysis right here has a 5-year revenue growth forecast of 11.38% and then an EPS growth forecast of 22.7%. However, take this forecast with a grain of salt simply because of the growth rates here in 2027, 2028. It's got 15.84 and 16.95, which is skewing the revenue growth right here. That being said, it does look like EPS growth is going to grow very consistently across the board, and we're looking at very close to 34% here in 2024 and then 10%, mostly because of the share buybacks. So we're going to use conservative figures, a worst case figure of 5%, a base case figure of about 10%, maybe 9% actually, and then a best case scenario of like 15%, just to determine the absolute value of PayPal. Now back to the spreadsheet, we could see that we've put in we've used a discount rate of 7% because this is an equity to firm model. We would actually use the cost of equity for PayPal. That number is 7.88, but their cost of debt is 8.81. So using a 10% figure does build in a bit of margin of safety, especially for the worst case. Now a 5% growth rate, a discount rate of 10%, and a 0% terminal growth, which suggests no growth after 2028, leaves us at a fair value of $81, which is 20% under the current share price of $64.59. The base case scenario uses a 2% terminal, a 10% discount rate, a 9% growth rate, same free cash flow, same cash, same total debt, same shares outstanding, everything else is the same. That leaves us at a fair value of $101, and we are 36.27% under fair value. At the best case scenario, we're using a growth rate of 15%, and that is pretty much, I would say, consensus. consensus, is anywhere from 15 to 22%. So using a growth rate of 15%, discount rate of 9%, a terminal rate of 2%, and then the same cash, total debt, and shares outstanding, we have a fair value estimate of $139, and that puts PayPal 53% under the current share price of $64.59. And this is exactly the reason why I decided to invest in PayPal. If we actually have a look at the worst case scenario being 20% under fair value, same with the base case, and the best case being significantly under its fair value, the risk to reward seems crazy, and getting PayPal at the current price is just really, really good value. And I see it as a value growth play, especially with revenue growth expected to grow 11% and EPS expected to grow 15% plus over the next 5 years. That does look like very good value for the growth that the company can put out. The reason why the share price is still depressed has to do with the fact that the market wants to see this new management team execute on everything they say they will, and that's improving on operational efficiency, innovating, executing on those share buybacks, and improving shareholder value in the form of increased free cash flow over the years, and getting back to the core of what PayPal is. Can the management team do it? We'll wait and see, but I believe that at the current price, PayPal is severely undervalued, and I have bought this stock with a huge margin of safety, even if we just look at the base case right here. But that is my breakdown of PayPal. I hope you enjoyed it. By the way, my end of year target for PayPal is $85, which is 20% upside from the current price. If you want more of these fundamental breakdowns of stocks, just leave a comment down below what stock you want me to check out, and maybe I'll do it in the future. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.